I've got £20,000.
A golden handshake.
Absolutely, that's the word. This program that was started, if you can get GP trainees to go and work in some areas, then there's an incentive. And we're getting inquiries like, what do I do with my golden handshake money? We're working towards an early retirement. So we're talking about financial independence, retire early. You start with two important concepts, your FIRE number and the 4% rule. So your FIRE number generally is equal to 25 times your annual expenses. So if you can get that and you get in the bank or investment, it's an estimate of how much money you need to reach a comfortable early retirement. People say money doesn't make you happy, but it can make you miserable if you haven't got any. If you have to go to work and you don't want to go to work, at that point, let's say you need a break, but you need the money. So we tend to suggest to doctors to invest in their financial education. That's rule 2.
My guest today is Dr. Andy, an ex-salary GP who is now an investor and helping doctors with their finance. Hi, Dr. Andy. How are you doing?
Hi, thank you so much for having me, Erwin. It's a pleasure and honor to be invited to your podcast. And I'm doing great. The weather is fantastic here in Devon.
So tell us a little bit about your journey.
Yeah, actually, so it's very interesting. I became an investor before I became a doctor, and I became an entrepreneur a bit early. So basically, I was born in I say a financially disadvantaged home, but let's not use that word. Let's just say I was born in a family not particularly wealthy, quite a lot of debt. Going to med school, I can remember, just like most people actually had a loan to go to med school. It wasn't very common at that point, but I remember we had to take out some money for that. But I just wasn't satisfied with sort of like, I looked ahead, I'd seen doctors and healthcare professionals that were already working, and I saw a lot of them struggling quite a bit financially. I mean, they had their paycheck, but that was just about it. So I got into learning about investing at about 18 or thereabout when I came across a book called Rich Dad Poor Dad. And I thought, well, I haven't got very much at this point. What have I got to lose? So that was around 19 or thereabout. After I started a business on campus, I started investing some of the money I got from the business. Along the line, these were tiny sums. But I started going a bit more and more into investing, and it got to the point where I was getting quite decent returns, and I started being invited to speak in events, seminars, conferences, my stockbrokers events. Your stockbroker knows your account, they know what's happening. But along the line, I carried all that alongside my medical degree, which I completed in Nigeria. It's almost 14 years now since I left medical school, actually. But it's been a fantastic ride since then. But after I moved to the UK, it's like I had to start all over again. Because I left medicine for 4 years. It got to that point where I could leave medicine for 4 years. I focused on other things. But when I came back to the UK, it seemed like I needed to learn the financial system afresh. So I had to make my own mistakes, learn quite a bit of information along the line, which I've been sharing privately and on different blogs and podcasts for years. Until last year when we launched MoneyWiseDoctor.com, which is basically a platform for doctors and healthcare professionals to learn how to make smart financial decisions. I think that's a long introduction, but
Tell us specifically about what are the things that you had to learn on your financial journey in the UK.
that's a good one. Just as a bit of background before that. So up to 2 years ago, because a very big question people ask is, there's so many 17-year-olds talking about finance. So why? What places you in that position? Why are you interviewing and screening financial advisors? And why are you making, I think we had 250 videos. I think one thing to think about is that 2 years ago, I was able to leave my salary job as a GP and walk away. So right now, I don't think about paycheck or anything like that. Obviously, I have income, but being able to set up my finances and figure out these specific issues helped a lot. I mean, in addition to having other businesses, but just being able to set things up. One big area I see doctors and healthcare professionals make mistakes is when it comes to taxes. A lot of times we have absolutely no clue. I was speaking with a consultant radiologist yesterday in a private session, and she only found out that she was in this 60% tax trap where her income and her taxable basically income, she had been pushed into an area where her taxes itself, she's being taxed far more than an average person, basically in the UK, because she's lost her tax-free allowance basic allowance. So this is just one example. There's other examples. For instance, you work as a GP. Some GPs are able to work with a limited company and they're able to have a better tax situation. Or basically things like not claiming tax relief or not even utilizing your ISA. I remember making a mistake when I started investing in the UK. I was very impressed with, okay, I want to do a very good investment, do my analysis. I'm in the school of fundamental investing analysis. Warren Buffett is somebody I've looked up to since I was very young. But I realized I hadn't invested in a stock and shares ISA, meaning that I lost the opportunity at that point to get tax-free benefits. Obviously, this was years ago. So this is just one area. You see, taxes alone is just one area we've just touched, but there are so many other areas like not having a plan, like not having a financial plan. A lot of times, just like you train doctors to prepare for exams, GPs, um, I'm sure one of the most important things is having a plan, a preparation plan. Most doctors tend to just move along in terms of their finances, believing that things are going to work out one way or the other. The NHS pension is going to sort out things, the government is going to take care of me. But that sounds very unlikely these days from the way things are going. It means that doctors need to have a better plan. Then there's the other mistake is not investing. So doctors can be quite good savers. We're risk averse, but knowing that with inflation, basically, if you just save your money and put it in, let's say you just put it in the bank, you might as well just put it under a pillow where there are termites, because you might come back and get some of it, right? You will get a lot of it. But think about 10 years ago, Erwin, what you could buy with £100 is not quite the same. So you need to invest to be able to get ahead. But the other aspect of it is also investing carelessly without understanding what you're doing. So there are basically 10 things. So there's 10 Moneywise rules we announced like that was February 2023. 10 Moneywise rules. I said to doctors, if you can go through these 10 things, it can help you take charge of your financial future. You don't really need to become a finance guru or an expert or anything. If you just fix those 10 things, then it places you in a position where you know, at least you know where you're going, you know the direction, and you have a plan.
Yeah, tax is something that many doctors are not very aware about. What are the things to look out for? Let's go over the 10 rules then, Andy.
The way I put it is not as good as the 10 commandments that were given to Moses. So I stopped short of calling it commandments when I wrote it down. And this has come from basically when people come and you're thinking, what are the basic things? Because an average doctor is a very busy person. They've got family, they've got career, they've got a lot of things going on. And if you wanted to tell them things, sometimes you need to put it down in simple numbers that they can just pick up and move on. So that's why we sort of like codified it to those 10 rules. But number one of the rules is you need to take charge of your financial future. You need to take control of your financial future. And what that means is you can't say, oh, I've got a financial advisor that is sorting out everything for me, or I've got an accountant that's sorting out everything for me. You could have a financial advisor if you want. Actually, we do recommend if you must get a financial advisor, ideally should be an independent financial advisor. That's a different discussion, and it should be a specialist who's experienced with dealing with doctors. But number one is even if you have a financial advisor, an accountant, or you've got an NHS pension, you need to take charge of your own financial future. You need to know what is going on. You need to own the plan. You might just have hired them to help, and that's what they are at that point, but you are in charge. And without number one, we might as well forget the rest of the 9 rules. Because only when you think, look, I'm in charge of this stuff, that you start paying attention to it. I'll give you an example. You're a GP, you have some people come to you and they think, oh, I'm not feeling well. Have you taken some paracetamol because you're in pain? No, I haven't. What have you done? I haven't done anything. So you're thinking, well, maybe this is a partnership. I can advise you in the medical bit, but you need to do something on your own. Let's say you have an injury. Have you rested it? Have you put some eyes? So even when you give them advice or you tell them what to do, they still need to go back and take charge of their health. They need to eat right and they need to exercise. So that's number one, taking charge of your financial future and being in control. But then it leads me to number two. Number two is quite huge and it's something we really hammer on at Moneywise Doctor is investing in your financial education. So basically, we study quite a bit as doctors. maybe in a year you might read several articles, and if you are still in active training, you probably study more. But a lot of times when it comes to something as important as our finances, because money is important, it determines your ability and your flexibility. It doesn't affect, yeah, people say money doesn't make you happy, but it can make you miserable if you haven't got any. If you have to go to work and you don't want to go to work at that point, let's say you need a break, but you need the money. So we tend to suggest to doctors to invest in their financial education. That's rule two. And what does this really look like in terms of investing in your financial education? Again, you don't need to become super nerdy about it and read economic history or read Adam Smith like I do, or other stuff like that. But you can do three basic things. And number one is read one good financial book every year. Just one is fine. You don't need to read many. It can be a no, not a podcast now, because that might be a bit of cheating. An audio book. You can read an audio book, you can read a PDF, you can read a physical book. Read just one good financial book every year. Books are not that expensive, but reading that is important. Number two, to invest in your financial education, we suggest attend at least one event, financial event. It might be a free event, it might be a paid event, it might be a seminar, it might be a workshop. I think earlier this year I was in Omaha for Warren Buffett's company's shareholders meeting, and that's my own event. It's one of my events for the year. So attend one event. It might be something local, but or even on Zoom, but attending one event is an important point to build your financial education because it helps you to stay updated. And number three is a weekly snack. It could be a podcast, it could be a newsletter, something that you just follow on a regular basis that just tells you, oh, this was going on. Oh, like for instance, pension allowance used to be £40,000. I think it was changed. Was it like a year ago or thereabout? Increased from 40 to 60,000. A very important fact that a doctor, particularly a consultant or GP or anyone earning above 100,000, might want to know in terms of their strategy for, avoiding that 60% tax trap. Or things being changed, like for instance, the introduction of, let's say, or the reduction of things like dividend tax allowance. If they say that there's a reduction in the amount of dividend you can take tax-free. So a podcast or a newsletter or a website or a blog or just someone who actually knows what they are talking about in that area, following it weekly could help. So in summary, investing in your financial education is three things: reading one book, one conference, and follow one blog or podcast. It's a topic I'm very interested in and very passionate about. All right. So, I mean, beyond route two, when you invest in your financial education and they are all linked together, route three is actually about having a defensive plan, finances, because a lot of times we run out to try to make money, but we don't think about what happens when things go wrong. So, route three is to have an emergency fund. So what that means, because I found out that even after I've written quite a few things about this, but someone was asking me last night, in the session I had, what does an emergency fund really mean? Does it mean just saving money? But to nail it down, it just means having 3 to 6 months worth of your living expense. So if your living expense per month is and your family living expense is 3,000, so emergency fund at minimum would suggest would be three times that amount, which would be about £9,000. And again, it varies. For instance, if you're in a position like myself, you don't have a regular salary job and you're not sort of like expecting, an income that's sent to you every week or every month, then it makes sense to shoot for a longer emergency fund, especially if you're running a business, you're starting a business, you're not sort of like living paycheck to paycheck. Maybe you might want to go 6 months or 12 months, depending on your risk appetite. So that's number three. Number four is basically beyond that emergency fund. And I just make a point, Erwin, about the emergency fund, because one question people always ask is, where should I save it? And I'll say, not in an investment, not in a bond, not in your friend who is doing a property business. It should be saved in an account where you can get it easily. A very good one is a cash ISA, any cash ISA, because then any interest you get on it is tax-free, and you can also access it whenever you need it. And you can use it for emergency, like things that show up. Let's say your boiler blows up or you lose a tire, then you don't become stressed And I say do this thing before you invest, because if you become stressed and you need to pull out money from your investment and you sell them before they become, they mature, or when they're actually grown, then you'll be setting yourself backwards. Right. So that's the importance of having that emergency fund. It reduces the stress as well. You don't have to worry about stuff so much. Number four is where it gets really quite interesting now. We say to set aside 15 to 20% of your income to invest for your retirement. I mean, if you've got your emergency fund, you're learning how to invest, you understand what you're doing, we recommend setting aside 15 to 20% of your income. Some people are stressed, they feel they're not investing enough. Some people are stressed, they feel they're investing too much. But having that sort of like heuristic, 15 to 20% as a guide, and I've met a lot of doctors who have really high savings rates. I've seen, I think I had a meeting with an A&E doctor in one of our Moneywise Doctor sessions in the community. She was saving 50% of her income, and she's been doing it for the last 7 years as an A&E consultant. And oh, wow, that's amazing. And I've met doctors who have absolutely no savings again. So, but my thought is that once you've actually gotten to the point where you have an emergency fund, then the next goal is to take the same money you are putting in your emergency fund, which should have been 20% of your income, now focus on investing it. So that's number four, basically. I mean, if I go into investing, that's a long discussion. Currently, I'm doing a 4-week master class, which is just doctors. It's totally closed at the moment. And the first day was 5.5 hours. So investing is an altogether different story. But basically, it's important to start investing, not something recommended by a random 17-year-old on YouTube who drives a Ferrari but lives in the parents' basement. Now, you're a doctor now, so we're all grown up. You've got to do things that think about the risk, the downside, and sort of like go for passive investment for most people who haven't got the skill or training to actually invest in, more sophisticated stuff. Right, so that's number four. And number five is shield yourself against potential catastrophic financial disasters. I mean, that's a mouthful, Erwin, but basically what it is to have some sort of shield. Like, don't just think, I mean, we're all optimistic, aren't we? We think things are going to go all right, but practically things sometimes go the wrong way. So having that sort of shield, and what this looks like is having your financial protection in place, like your life insurance, your income protection, and sometimes for people who need it, critical illness, as well as looking at things like making sure you have your MDU, medical defense. Obviously, there's some we don't tend to mention, like having your car insurance. If you don't have it, you can't drive anyway. Just having that shield in terms of that next layer, that even, okay, let's say things go wrong, you start spending your emergency fund, and then there's something else coming out. A practical example. On my podcast, I did have this consultant radiologist a few months ago, who unfortunately had some visual issues and had this eye problems and so much pain. So she couldn't do very much of her work as a radiologist and had to leave her job. And what really helped her at that point was that she had her income protection that she had started paying for in her 20s. So basically being able to fall back on that. And since 2020 till 2024, they've had to be paying her. And the key is to get the right income protection that is occupation specific. So that's why it's really important to deal with, a qualified advisor who understands working with doctors, not just any random person. Yeah, so that's sort of like the first five rules, and there are a few other things to consider. For instance, you look at passive investing. We tend to suggest to embrace passive investing for doctors. I mean, I've been an investor for 19, going to 20 years now, and when I started investing, I didn't know anything about index funds. What is index funds? I generally started by learning fundamental investing. Thankfully, I didn't have much capital at that point, which gave me the opportunity to learn slowly. I've invested in quite a few companies, but I've noticed that with doctors and healthcare professionals, being too busy, not having the time to actually go into nitty-gritty of learning how to analyze companies, the amount of work that goes into it, sort of like even getting on investors' calls, digging through, reports, company reports, and analyzing it, and still not being 100% sure. So every now and then I publish my investment returns, and once I did that on a doctor's forum, and it was quite a bit of a rumble because, oh wow, this is amazing. How did you do that? But the other side they're not seeing is the risk. So going forward, I tend to recommend, and the same thing I'm doing for my little ones now is focus on passive investing. For a doctor, low fee, broad, well diversified index fund, then you can go off and do whatever you like and come back and look at it every quarter. So that's the other rule. Embrace passive investing over active investing, because it also means you don't end up spending so much money paying fees to a random hedge fund or fund manager or advisor who claim they can get you better returns. Because you're doing it passively also, it means that you can do it in a systematic way where you can set it up to go, on monthly basis. You can fix an amount you want to invest, which would be about 15 to 20% of your income. Yeah. So, but if you want to look at the other rules in the 10, because quite a few of them, there is basically find your financial dream team. By what I mean by that is you need advisors. The financial advice industry, they probably look at us and think, well, we want them to be burned down. Far from it. We're just saying that when a doctor who works in a high trust environment, you as a GP, when people see you, they believe what you say because they think, well, for you to work as a doctor, you have that minimum required integrity. So that's the health sector. Now, compare it to the financial industry sector, which obviously, if I were to say to you, who will you trust with your life? The first person you will say is a banker, says no one, or a financial advisor, says no one. But that doesn't mean that there are no good ones. But now the key is before you go into work with an advisor or an accountant or even a lawyer, you want to figure out what are their credentials, who have they worked with, have they worked with other doctors, do they really know what they're doing, what are their reviews and all that kind of stuff, because these are people that can actually make or mar you. So this is just your financial dream team. But they just three more money-wise rules. Like I said, they're not commandments, but they are helpful. And the eighth one basically is a seventh one rather is keeping your expenses and taxes in check. So at the beginning we talked about mistakes doctors makes about around taxes, but just sort of keeping an eye on it, make sure you're not overpaying your tax. And again, what this looks like is read one book, attend one seminar, and follow a podcast. It might need you to sit down with a financial advisor or a coach to sit down and walk through your taxes. It might need you to take out half a day. If you take out half a day in a year to just look at your tax situation, and I mean 4 hours, it might be your most profitable 4 hours in the whole year, identifying is there something I can do about my tax situation? Right, okay. So the last two rules I would say are a little bit further down the line, because the last two rules you're looking at things like sort of your legacy. Rule 9 is manage debt effectively. So be careful. I don't want us to talk too much about debt, but we all understand how people can borrow so much money just to try to look impressive, to buy the latest Tesla. And I love Tesla, but if you're going to buy it and you're buying it through your limited company as a company, company car, and obviously use it for your company business, is very different from you taking your salary and then borrowing some extra money and then buying a car that is double your annual income. It sounds a bit silly. And if you love cars, I do like nice cars as well. I've got a couple. If you love cars, okay, that's fine. You can go for it. But saddling yourself with debt, it reduces the chances that you can have that extra income to invest. So managing debt really carefully, paying down high interest debt. For instance, if you've got a credit card that is 25% interest, you want to be paying that down before going to do an investment that will give you 10%. And if you want to buy a house, yeah, I'm all for a dream house and all that. But I really need to be thinking, if I buy more of this house, does that mean that I have to work some extra hours and I'm not owing that much? And let's say I want to go and start an exciting new business and I can't even leave because I'm saddled now with a car payment or mortgage. So since you've gotten this far and you haven't turned off the camera, that means I can give you rule 10, which is something that most doctors don't even consider at all, is planning your estate and succession. So basically what it looks like is I'll give you a practical example someone in our Moneywise Doctor community brought up. A very, very excellent surgeon, sorry, not a surgeon now, physician, retired in her late 70s, passed. She had done quite well financially, left her house in London for her family. The house was valued, I think, was it about, I can't remember the exact amount, but it's in millions. But what I do remember is that they received a bill for inheritance tax for about £450,000. Now, for the family, they haven't got that money. And for them to do that, to pay, they need to either sell the house or let the taxman take the house and sell it. So it just introduces another dimension of stress, isn't it? So planning that legacy, for instance, you have a life insurance policy, and I tend to say to doctors, get a decent life insurance policy. Don't, I mean, I lost a colleague of mine last year, a surgeon, fantastic guy. We're about the same age, childhood friends, a surgeon in London. And I know it made me sort of become a bit more hot on this subject of life insurance and all that. But I'll say get a decent sized life insurance if you can afford a good one. And life insurance are usually quite cheaper compared to income protection and all that. So now imagine you've got a life insurance, and let's say someone passes. Obviously, it's easier to envisage this if you've got children, and your children or your spouse, they get a life insurance, but then they have to pay tax on it as well. But if the life insurance, for instance, about estate planning now we're talking about, is sitting outside your estate, let's say is in a trust, in that case, it's not part of your estate. So when they look at the inheritance tax, that's not some of the things that they will have to look at. They can actually get the full life insurance. So that's rule 10. So as you can see, the 10 rules tend to tie into each other. But if as a doctor, you can sit down once a year, half a day, check, 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 and say, I'm doing these things, you would be in a much, much better place. And your life will not be totally dependent on when NHS pension will be and whether it will be moved from 68 years to 78 years.
Thank you for sharing this. So yeah, I think there's quite a lot of insight in these 10 rules. And I think what I would say here is that you have to do your own research and see what fits for you, because these rules are what you found good for you might be different for some other people. And in finance, it depends on your time horizon, what you're planning, and everybody has got individual plan. So tell us about the financial independence. What do you understand by financial independence?
Yeah, so that's a very good point you raised there. So personal finance is very personal. And for some people, is about even spending more. They need to spend more and take out a bit of time. But if you want to look at financial independence, basically, for most people, there's different definitions. But the practical way I look at it is, if you get to the point where your passive income can actually pay for your lifestyle, you get to that point where you can actually take out, let's say, time from having to work for a paycheck, and you don't have to cut your lifestyle. That is sort of gives you a financial independence, basically. But this is different pictures. Like you're pointing out, different people have different goals. Different people have different goals. For someone, it might be like financial independence is being able to, like I said, the last time I was in a GP surgery was 7 months ago. So financial independence for someone might be being able to take out a year to travel. I've got a colleague now who's sort of like traveling around the world. She's taking out time. She probably has gotten into that financial state where she could do that and not have to rely on a paycheck. Now, that's one way it could be. For someone else, financial independence might be having several millions of pounds in the bank. But a good way to look at it, there's this rule of 72 that was quite popular. And I'm very careful with numbers. When it comes to rules and numbers, I'll say you have to still sit down and figure out what works for you. But basically, what it's looking at is by the time you have investment and returns that are enough to actually pay your, I think leaving it loosely like that, they're actually able to pay for your lifestyle. That's the point where you can say you're financially independent. What that really implies is that if you want, you could cut down your cost or increase your income. For instance, if you look at a fisherman living in a rural area and they spend absolutely, what am I talking about? A fisherman, actually. I've got like, I think one of the drivers that worked with me in the past, he said to me that his monthly expense was £650. I don't know, for someone outside the UK, it might sound like, oh, it's a lot of money, but I live in Cornwall and Devon area, so £650, that's amazing. If he's able to figure out or have enough money that can last him for the rest of his life, at £650 per month times 12, without having to work. And of course, you have to factor in a growth percentage, saying that your money is growing in an investment, which could be a well-diversified mix of index funds and bonds or whatever you save, probably growing at about a percentage, let's say 7 to 8%, looking at historical returns of the stock market. So being able to achieve that point is what we refer to as financial independence. Of course, there's the fire movement, financial independence and retire early, which makes it more exciting. But just understanding, okay, I get to this point. And for some people, it might be a partial retirement. Let's say you're a doctor, you were working full time, but you were investing quite vigorously, you were timing things, and maybe you got to 40 or 45 or 50, and you can decide, I want to work 2 days a week now. So this is sort of like, it's not quite there, but you're moving in that direction. Yeah, so I like to give you that general framework, and then people can work out what really works for them. Because some people might want to keep working till they're 80.
Yeah, the different choices in life. So tell us about your own decision, as in you stopped being a salary GP, and financially, how did this work out in your mind?
Right. I mean, to be honest, I didn't start from when I became a GP. I think I had that plan already for years. It's just that things take longer than we think. So I started investing at 19, had a couple of business on campus. One was a SaaS, so software as a service business, instant web SMS that help people to send broadcast messages and all that, which is very common now. But in 2010 or in 2009, I was like, oh wow, you've got this stuff. Had a bit of a clothing business, because when I spoke in youth conferences and seminars, people say, I love your suits. Is that designers? I'm like, no, I've got a tailor that made it for me. Then we launched the business basically. So the idea was like, look, okay, by the time I'm 30, I should be done with all that. But I think it took me like, I think I was about 36 or thereabouts by the time I left my salary GP job. Now I'm closer to 40, not that far away from 40. But it's sort of like being able to sit down and work out what is my annual expenses really. What is my monthly expenses? How much do I really need to run my expenses? I mean, we're talking about, if you go down to the micro now, you're talking about your mortgage, if you've got a mortgage, you're talking about rent if you pay rent, you're talking about things like car payments. I mean, to get to that point, I decided no car payments, pay off my car, the next car, I'll buy it cash. And sort of that's for me, that's not what I'm recommending for everybody. But it's sort of like being able to get to that point where you are in charge, you're taking charge, you're making the decisions. Credit cards, yes, but we pay off in full. It's all set up on direct debit full, and that goes away. So you're using your credit card more as a sort of like a way to use the bank's money ahead of time, and also to avoid hackers from getting into your debit card and all that. So this is what it looks like in practical terms, being able to sit down, where can I cut waste? I'm a member of this club or that gym, and I'm not going because I go for a walk. Can we cut that out? Why am I using a mortgage of interest rate of so and so when I can get, so sort of sitting down and doing that financial review is not fun.
Mm.
And if you're married, then you need to deal with your partner who might not be as interested. So you have to bribe them, take them out to a nice dinner or whatever. And then if you've got kids, you have to factor in things like education. That's sort of the point where you work out, okay, what was my freedom number? What's my fire number, basically? Um, and again, I'm very careful with giving the actual numbers that people do need to work towards, because things change and different people can actually have different targets and different lifestyle. Somebody might want to move to a lovely villa in Italy and then be able to live on Lake Como. And another person is just quite fine to live in Devon and be able to go for a walk in the woods. I mean, I get a lot of boost from going for a walk every day in the lovely Devon. So this is sort of how we walked around these things. And then you
Mm.
look at your investments. If you're investing, what are the returns? Are you getting dividends? What are your current investment? If you sell them, what's the face value? You factor in, do you need a mix of bonds? So bonds are less likely to, there's no fluctuation in terms of you're going to get your full capital at the end with bonds. Most people don't know the price of bonds can actually go up and down. Then you look at things like your life insurance policy. Okay, yeah, it's all good. I've got some income, but if I have to stop working now, is my family all right? Are they going to struggle? Then look at, okay, I've got a couple of properties. If you've got investment properties and you look at them and you're thinking, okay, can they pay themselves off? And if anything goes wrong, or if I'm no longer here, again, if it doesn't need to be liquidated, really, okay, you say, okay, well, so my life insurance policy will cover for that to make sure that it doesn't have to be sold because, it pays out. So these are the thoughts that went around me before I got to that point where I was like, okay, I love being a doctor. I think it's a great privilege, but I want to be able to do it at my own sort of like pace. I want to be able to do it also. I have much more fun. At the point I was working 1 day a week, I looked forward to it because I had much fun to catch up with Mrs. Megan, the 81-year-old who I hadn't seen, and they teased me and asked me how I've been. Yeah, this is it, and it's not the same for everybody. I mean, I've spoken to a surgeon who, for them, they really love what they do, but they also want to go into coaching because they enjoy coaching, but they couldn't find the time. So they had to make a decision on if there was a way to cut down on their hours, but not miss out that money from surgery, or be happy to miss out that money, knowing that in the future they might build alternative sources of income, or be happy that what they're going to earn from working part-time might sustain their lifestyle. Yeah. I don't know if that helps, but that was the sort of framework I used to look at it, Erwin.
Yeah, I think that's helpful to see your thought process when you thought about it. Because I know some people, they don't plan about everything and they don't know what other things to think about. And it's good to walk us through what your thought process was. I think it'd be helpful to know about the investing. You mentioned about index investing and 15 to 20% of the income. So what's your allocation in terms of the investment and different vehicles?
Okay, that's a very key technical question. But before we do that, let me just sort of look at this fire number 10 because some people are hung up on fire. It's really, I think sometimes Royce, I'm trying to remember this guy that said things that are not measured are just as important, but we tend to over-index on things that we measure. I think it was Roy Sutherland or somebody from Ogilvy. So those numbers, fire numbers, I think people get hung up on it. But I'm just going to sort of break it down in case somebody is asking what is your fire number. So if you're working towards an early retirement, so we're talking about financial independence, retire early, you start with two important concepts, your fire number and the 4% rule. So your fire number generally is equal to 25 times your annual expenses. So 25 times your annual expenses, if you can get that and you get it in the bank or investment, is an estimate of how much you will need or how much money you need to reach a comfortable early retirement. Now, we live in an imperfect world, so we know that things might not exactly work out that way, and it also depends on what age you start that you want to retire. And then the 4% rule is mostly looking at how much you're withdrawing, your withdrawal rate, how much you withdraw. Again, lots of variables. These things could be affected by inflation. So that's why I say have it as a heuristic, as a general number, but don't get too stuck on it. Now, let's look at asset allocation because one whole class in our master class was asset allocation. When you talk about asset allocation, basically is more like you're talking about where you put, let's say you've got like a pie, how you divide the pie, isn't it? Yeah, how you divide the pie, where you put things. I usually would say out of the 15 to 20% of the money that is going into planning and investing and saving for your retirement, that is the pie. So the pie is not every income you get. The pie is that particular amount that I would usually say, let it be on a direct debit, set it automatically so you don't have to think about it. I sit down, you want to do your asset allocation. The key thing to consider is what is your risk appetite? So by risk appetite, it's basically psychological. I've had times when I think I invested in a company. So I've done a bit of angel investing. I also invest in individual companies in addition to index. So I've had times when I bought a company because the whole market was selling it off. And I looked at their financials, I knew the management, and I thought this is an excellent, I can't believe everyone is certain. And that doesn't mean I'm right 100% of the time, but if you're right more times than you are wrong, then you have a higher chance. Again, I would recommend people go passively, but if this is an area you're going, because if you're talking about asset allocation, that's something to think about. So your risk appetite is one thing, the psychological part of it. Number two is your risk capacity, because you might have a high risk appetite, you're not worried if the market is crashing, but you might not have the capacity, meaning that if you're 65 and you're retiring in 2 years, or if you're, let's say, 60, you're retiring in 5 years, and you haven't invested much, you might not have the capacity to take more risk compared to a 25-year-old who is a doctor, has got a couple of businesses, and has a 40-year investment, timeline to invest. So these are two things to consider in asset allocation. The second thing the third thing I'll say is basically your skill. What do you know already? Again, for the vast majority of people will be fine from just buying well-diversified broad index fund and all that. But if, for instance, you've got a lot of experience in buying debt and sort of like you have experience in dealing with special situation investments, or you've been part of a venture capital fund, or you've done angel investing, that's very different, isn't it? So when it comes to asset allocation, the first thing I would say, one is cash. You need cash. So that's your emergency fund. That's 3 to 6 months of your living expenses. A lot of young people might say cash is trash. I don't really think so. Cash is not trash. A lot of nonsense YouTube, Instagram advice, basically, that is not based on lived experience, might say cash is trash. No, you need that cash cushion there. I'll say 3 to 6 months, even longer if, again, you don't have a regular income. So that's number one. Number two, there's stocks. Obviously, when it comes to stocks, basically people think of individual stocks and index fund. When you're allocating funds, they are all in the same basket. I mean, you can go and divide them a little bit, but if you're going to invest, especially when you're younger, some financial advisors will use the heuristic 100 minus your age. So if you're 30 years, they might say 100 minus 30. So put 70% of the investable assets in stocks and 30% in fixed income assets like bonds, treasury bills, gilts. I don't really subscribe to that. I think when you're younger, especially for doctors who didn't necessarily start investing early, a lot of times in medical school, before you hit your maximum earning capacity, you might well be into your 30s or even much later when you're a consultant. So at that point, you ought to be investing a bit more aggressively, and maybe you might start down fine-tuning things when you're closer to 60 or 55, whenever is your retirement age, maybe 5 to 10 years to that. So this is just an example. Now, bonds don't account for a high amount of my holdings. So basically that might change when I'm 60 or 50, thereabout. But 10% will probably that bonds, that fixed income asset, you just put in some amount in there so that, okay, it's just a cushion, and it's because the market could go up or down. Sometimes that allocation to bonds could rise, like when there's not enough good bargains in the market for me, and I'm looking for fixed income assets, and I'm saying, oh, gilts are paying 5%. I have some of that. So these are things to consider. But there is also an allocation that will make for, I'll call speculative investments or speculative trades. Like I've got a mate who has recently, he has a startup in the US. He was a doctor in the UK, but he's moved to US. He's got some funding. He's been through an accelerator, and they might be raising funding. And I'm thinking, this guy, there's a high chance he might fail, and there's a high chance he might succeed. It's 1%, and I have a fund that could be for such speculative investments. And if you're a doctor or healthcare professional, you don't really understand how to assess investments or weigh them. You might be better off putting the bulk of your investment in stocks and shares through index funds passively. Could be a global index. But any money you decide to invest in individual stocks, you must consider as speculative. I think so, because they have a much higher risk. I wouldn't allocate more than 5 to 10% of my investable assets in speculative funds, basically because there's a high chance of it not working out. And there should be a chance that if it works out, it should give me 10 times at least of my returns rather than twice or 3 times. Does that make sense? I try to avoid any technical jargon.
Yeah, that was good. So I think it's good to see that there's different vehicles people can actually invest, and it's really important to highlight that with this investment you could lose your whole capital. So you don't want to get wiped out. So that's why you don't put all your money, which you mentioned about. It's one of the pies. Yeah.
Absolutely. So that's the thing with investment, there's always risk. I think it's misleading when financial advisors tell people that you can't lose on bonds. I'm like, hold on, how far have you been looking at? 151 countries have defaulted on bonds since the last 60 years. 151 countries. And you might be surprised, not these are not like startup countries. They have people like Russia, Mexico, Argentina, regular customers. You've got several other countries that have defaulted on bonds. And also, you look at it, if you look at the king, let's say, was it the Empire of Russia? Let's say in 1910, and you're looking at the Empire of Russia, and you're looking at Great Britain. They look like similar Western countries being ruled by cousins. And if they sold bonds, because bonds is basically you're lending money to the government, right, or to a company, depending on who's providing the bonds. If the Empire of Russia, which looked like okay, yeah, this was is a Western country, you wouldn't have been able to predict that in 4 years, 1914, there was a revolution, and then the bonds were nothing better than a beautiful wallpaper, whatever your bond coupons are. So that's why there's a risk with every investment, whether it's real estate, whether it's stock market, whether it's index or bonds. It's just that all the risks are not quite the same. For instance, if I'm buying a random tech company that just start up, if I'm investing in it, the risk is obviously far more higher compared to me buying gilts. So gilts is UK government bonds. Or if I'm buying like US treasuries, the risk is not quite the same. So because if I know that okay, as long as the UK government is existing and the US government they have capacity to at worst case scenario print money and pay me. So if they're going to give me 5% returns, if I'm going to invest in something else that is riskier, I should be asking for a far much better return. This is what we call risk premium. Okay. So this is it. You can lose all your money, entire money in investing. But again, even saving as well. Some banks go bust and people lose their money. I know that in the UK, there's FSCS coverage up to 85,000 of your money if you save your money. But apart from that, the other danger of just saving is inflation and your money not being enough. That's why a percentage should go for investing, but don't neglect your savings at all.
Yeah, I think it's very important for people to understand that. So, what is the best advice that you've got about investing then, Andy?
I think the most important part I would say is to get financial education before investing. That's the most important thing. It doesn't matter what sort of returns you get. I mean, if I look back 4 years now, maybe, or just in the last year, we're doing about 83% returns on my portfolio. And there are years maybe we did 50 or thereabout, and these numbers don't really mean anything until you see what amount of risk did the person take to get it. So risk adjusted returns. So I say if someone looks at my results, the first thing people say is, what did you invest in? I'm like, that's a wrong question, really, because whatever I invested in has moved on by now. The question might be, what's your process? How do you arrive at that? Or better still, if I'm asking people what to invest in, maybe I should just buy a broad diversified index fund. And if I don't understand what it is, I shouldn't be investing in it. I should go and understand it first. So I think the most important thing is financial education before you start investing. But the second one is risk management. Risk management. So you asked me a very important question. Asset allocation is a weapon of risk management. It's asset allocation, isn't it? If you allocate your assets and you've allocated in such a way that you've got your cash, you've got your low risk investment, you've got your index fund, you've got your fixed income assets, you need to manage your risk in such a way that not one thing or there are less chances of you being wiped out by something going wrong, because you can go and trade options or do some exciting exotic stuff, make a bit of money. 5 years later you are minus, you're in debt. So asset allocation and risk management is important, but before that, the key thing is financial education, because we've got recently several GPs asking us questions, not GPs, GPs registrars sending us we have a few thousand subscribers that get emails from us every week. And we sometimes get emails, and one of the commonest things we've been getting since August was, I've got £20,000 from my TERS. You know what TERS is? Like a welcome bonus for your.
It's a golden handshake, is it?
Absolutely, that's the word. The golden handshake, that's the word we use for it. So if for your international audience or non-GP audience, so there's this program that was started. If you can get GP trainees to go and work in some areas, then there's an incentive. It's 20,000, but it's not 20,000 because everything is taxed. At the end of the day, you might end up with 10,000, 11,000. And we're getting inquiries like, what do I do with my golden handshake money? Like, first of all, I can't give you personal financial advice. I'm not your financial advisor. But as it were to speak generally, the first thing you ought to do is to put that money in an account that will be getting you an interest. Better still, a tax-free interest in ISA, and then sit yourself down for the next 90 days or next to get a decent financial education. Understand what is your risk, what have you already invested in, what should you be doing next, and of course, look at things like paying off any high interest debt that you already own, saving your emergency fund before you even start to talk about investing. I think there was a video we did, 7 things you need to do before you start investing. So this is what we generally recommend. Obviously, it's not personal financial advice. You're listening to two blokes talking on YouTube, and you can make your financial decisions just based on that. But yeah, that takes me back to the key first thing is get your financial education. With those 3 things, read one book, attend one seminar, or follow a podcast or a blog. And if you need to, you can get a financial advisor, a financial coach, or sit down or join a community. There are lots of communities now where people discuss finances and you can ask questions and, basically, um, just improve in that area generally.
Thank you very much for sharing your insight today. And where can people see what things that you've got online about your blogs?
Yeah, well, first of all, thanks again for having me. I love the fantastic work you're doing. I think if I was when I if back then when I was a GP registrar, if I had resources like that, it might have made my training days easier. Even though training in Cornwall was one of the best gifts, it was a fantastic training. Yeah, but to find me is moneywise doctor.com. And if you want to sort of like get on our mailing list so that I can send you useful information, is moneywise doctor.com/subscribe. The first thing, one of the important things we say to people when you get on the homepage is to do your financial health check. So there's a quiz, it's sort of like a score that can take you through different areas of your finances. Anyway, people on the mailing list, that's the first thing they get anyway. It's one of the first emails they get. Take you through as a doctor in terms of your earnings, take you your taxes, take you through your investment, walk you through that so that you have an idea of where to start from. But on LinkedIn, I'm Dr. Ndubuisi Andy Egwim, as you know. But the website is moneywisedoctor.com.
Thank you very much, Andy. And let us know what you thought about this interview with Andy. Share in the comment section what was your main takeaway. Take care, everybody. Bye-bye.
Thank you, Erwin. Cheers. Bye.